Welcome to The Explainer. Today, we're tackling the private equity paradox. Is it booming or is it collapsing? We're unraveling a massive, literally trillion-dollar mystery right at the heart of our financial system today. Now, on the surface, you probably think you know the story, right? Billionaire investors, massive corporate buyouts, endless profits. But right now, there is a completely baffling paradox unfolding behind closed doors. We're seeing numbers that absolutely contradict each other. The industry is out here reporting record-breaking successes in one breath and historic, devastating losses in the very next. How is that even mathematically possible? Well, buckle up because the story we're diving into today involves artificial growth, hidden debt, VIP-only stock markets, and a looming software apocalypse. Let's jump right into the data. $717 billion. Just let that massive number sink in for a second. According to the data, in 2025, private equity supposedly had its second best year in history when it comes to exits, which, just means selling off companies they previously bought. When you hear a number nearly hitting $750 billion, you immediately think, wow, this industry is absolutely booming. Money is flowing, deals are closing, and everyone is getting incredibly rich. It sounds like a flawless victory, right? But here is where the story takes a really sharp turn, and we hit the core paradox of this entire explainer. If this industry is generating hundreds of billions of dollars in exit sales, why aren't the actual investors getting paid? Even more baffling, how can an industry with nearly $1 trillion in sales simultaneously report its second largest loss ever? Are you starting to see the contradiction here? It is a massive, glowing red flag. Okay, let's break down this paradox. On one side, you have the flashy headline, the second best year ever, with $717 billion in exits. But colliding right into that is a brutal reality. The industry just suffered its second biggest loss ever, and payouts back to the actual investors have completely cratered to levels we haven't seen since the global financial crisis of 2008. So the money is moving, sure, but it's definitely not making it back into the pockets of the people who actually funded these funds. And this right here brilliantly illustrates the underlying problem. It all comes down to just 14%. That is the percentage of a fund's total worth, its net asset value, that has actually been distributed back to investors. Actual realized payouts have just flatlined at this dismal 14% for 4 straight years. That's a modern record for the private equity industry, and trust me, it's not the kind of record anyone wants to break. You really have to ask yourself, if they're supposedly selling all these companies, where on earth is the cash going? Why are the returns looking like it's 2008 all over again? Well, to make matters even worse, there's a staggering figure sitting quietly in the shadows. 32,000. That's the number of unsold companies currently sitting in the private equity inventory. We're talking about local dentist offices, plumbing companies, nursing homes, and yes, even YouTube channels. They bought up all these small to medium businesses over the last decade, planning to flip them for a huge profit. But now, the music has totally stopped. They're sitting on a bloated inventory of over 32,000 businesses that they simply cannot find buyers for. So the crucial point we need to figure out is this. Was that $717 billion in 2025 genuine, organic economic growth? Or was it just a desperate going out of business sale? Because remember, 2025 was the first time in years that interest rates came down a bit, and the FTC softened its regulatory oversight. Money got a little cheaper, and the rules got a little looser. Did private equity firms simply use this brief, tiny window to completely rush for the exits? Now, what's absolutely wild is the massive discrepancy hidden right here in the data. The total dollar value of the exits shot up by a massive 47%, but the actual volume of companies being sold, that fell by 6%. I mean, how do you make 47% more money selling 6% fewer things? The answer is that the average deal size was pushed to a record $1.2 billion. The growth wasn't broad across the market at all. It was entirely top-heavy. In fact, without massive outlier transactions, the traditional private equity market is actually shrinking. Just 13 mega sales accounted for nearly a third of all transaction value in 2025. We're talking about giant anomalies like a $55 billion buyout of the video game company Electronic Arts, which was backed by the Saudi Sovereign Wealth Fund. If you remove those 13 giant deals from the equation, the regular businesses aren't really selling at all. So, what do these fund managers do with those 32,000 unsold companies as their funds reach their typical 10-year expiration dates? Well, they use something called continuation vehicles. Honestly, this is just a fancy finance bro way of explaining a very simple trick. Imagine a winery that's supposed to sell its wine after 10 years. Instead of finding a real buyer, the winemaker just pours the old wine into a brand new barrel, slaps a new 10-year label on it, and officially sells it to themselves. This allows them to reset the clock, hide the lack of buyers, avoid taking a loss, and keep charging their investors massive management fees. A huge chunk of that 2025 boom was literally just funds trading companies to themselves. Now, I know what you might be thinking. Okay, so they play some accounting games, but these are still solid companies, right? Well, let's move to a specific case study to see how this rot works in real time. I want to ask you a question. How does a perfectly functioning, profitable company completely collapse and get handed over to the banks literally overnight? Let's zoom in on the software company Medallia. By tracking the major private equity firm Thoma Bravo and their deal with Medallia, we can see exactly how absurd financial engineering destroys good businesses. Step 1. They bought Medallia, which makes consumer feedback software. It was a slightly boring but very profitable company. Step 2. To buy it, they piled on an estimated $1.8 billion in private credit debt. Step 3. Interest rates rose, meaning the payments on that floating rate debt absolutely skyrocketed. So what was step 4? Instead of using their cash to pay down the debt, Thoma Bravo simply walked away. They handed the keys to the lenders and took a massive $5 billion loss. The company was still profitable, but the debt structure completely crushed it. This perfectly highlights just how irrational this market has become. This is quite literally the equivalent of you putting 80% down on a rental house that makes you money every single month. Then you borrow the last 20%. But the second your mortgage rate goes up, instead of just paying off the loan, you let the bank foreclose on the entire house. It sounds completely insane, right? But they had the cash to save the company, and they chose to hand the keys to the lenders rather than pay the rising interest. So if the traditional buyout model of flipping small and medium businesses is struggling this much, and if they're literally walking away from multi-billion-dollar software companies, we have to ask a massive question. Where is all the big money actually going? Because the wealthy institutions aren't just stuffing their cash under a mattress. They are quietly rewriting the entire structure of the global stock market. For years, we've known that the wealthiest top 10% of households owned about 93% of the public stock market. But recently, you might see that the top 10%'s grip has actually dropped to 87%. Now, on the surface, you might hear that and think, hey, great, the market is getting more equal. But please, do not celebrate just yet. Because the reality is the ultra-rich haven't lost a single dime of their wealth. It's simply moved into gated private markets that regular, everyday investors cannot access. Large, stable companies are figuring out that they don't need to go public on the S&P 500 anymore. They can just sell themselves directly to institutional investors in the private market. This simply means wealth is more concentrated than ever, with private equity transforming into a glorified VIP-only index fund. But even inside that VIP room, there is a massive storm brewing. All of this buying, all of these mega deals, and all of those clever continuation vehicles were fueled by an ocean of private credit, basically unregulated high-interest loans. Which brings us to the terrifying reality of 2026. What happens when the cheap private credit completely dries up and the risky loans that propped up this entire VIP market start to default? We are now watching a brutal transition in real time. We're moving directly from the artificial highs of 2025, which was fueled by cheaper money and funds desperately making up for lost time, straight into the severe consequences of 2026. We are slamming into a brick wall that industry insiders are literally calling the SAS Apocalypse, combined with a massive freeze in the credit markets. Let's break down the SAS Apocalypse because it is absolutely staggering. Over the last decade, private equity portfolios were stuffed with software companies. But suddenly, fears over AI replacing enterprise software have completely decimated valuations this year. Businesses realized they could use AI to write their own code instead of paying for expensive subscriptions. In just the first quarter of 2026, $1 trillion in market cap was erased. Revenue multiples were slashed nearly in half. And if you want to sell a software portfolio right now, good luck, because buyers are demanding massive 20% discounts across the board. And this sheer panic caused a massive freeze across the entire board. Total private equity transactions plummeted by an astounding 67% in the first half of 2026. Minus 67%. Nobody wants to buy and nobody wants to sell at a loss. The power to the entire building has basically been cut. And when transactions freeze like this, the debt that relies on those transactions starts to crack. And here is where it gets genuinely scary for the financial system.
In Q1 of 2026, 5 of the 6 major private credit funds literally gated their investor withdrawals. That means investors saw the writing on the wall, tried to pull their cash out, and the funds locked the doors to stop a digital run on the bank. And as defaults begin, like the massive Bain Capital European loan that recently went under, they simply do not have the liquidity to let people take their money out.
Which brings us to our final and frankly most important question. We started by looking at a trillion-dollar paradox, a market claiming record success while simultaneously hiding historic losses. But with software valuations completely crashing, deal volumes plummeting by 67%, and major credit funds literally locking their doors to investors, you really have to wonder, will this ticking time bomb in private credit finally force this irrational market to completely crash down, or will they somehow find another clever trick to extend and pretend? Keep a really close eye on this space because when a trillion-dollar bubble pops, absolutely everyone feels the impact. Thanks for joining me on this explainer, and we'll see you next time.